All right, let's dive into CenterSpace's Q2 2025 earnings call. Now, this one's a really interesting story because on the surface, everything looked pretty solid. But then, the stock dropped. So what gives? What's really going on behind the scenes? Well, we're going to break it all down.
Okay, so here's the central puzzle, right? On one hand, you've got CenterSpace absolutely crushing it on their operations. I mean, their core FFO, a super important number for these guys, came in better than expected. But then you look at the market's reaction and the stock actually closed down. So you've got to ask, why the disconnect? What did Wall Street see that made them hit the sell button despite the good news?
All right, to get to the bottom of this, we've got to look at the headline numbers. And really, it's a tale of two completely different stories. You've got the story of their core business, which is humming along nicely, and then you have the official accounting number, the GAAP number, which got slammed by a big one-time charge. And that charge? It's all tied to their big new strategy.
Okay, so let's start with the good news, and the number that REIT investors really care about, core funds from operations, or FFO. You can just think of it as a much cleaner way to see the actual cash a real estate company is generating. And what happened here? Well, CenterSpace reported $1.28 a share, which was a solid beat, no two ways about it. This tells you the underlying cash-generating engine of the company is running strong.
And that strength wasn't a fluke. You can see it right in their existing properties. We're talking about their same-store portfolio, the apartments they've owned for a while. Their net operating income, which is basically the profit from those buildings, grew by 2.9%. Now that is some healthy organic growth. It shows you that day-to-day management is, really on point.
So if the core business is so healthy, why did the official GAAP number look so bad?
Well, it all boils down to a big, one-time, non-cash charge. It's basically an accounting rule. Since CenterSpace is planning to sell a bunch of its properties, they have to write down the value on their books. But here's the key. No cash actually left the building. It's just a paper loss. And that's exactly why we focus on core FFO. It strips out these weird one-time accounting quirks and shows you that, yeah, the actual business is doing just fine.
And that accounting charge, well, it's actually the breadcrumb that leads us to the real story of this quarter. We're talking about a massive, aggressive plan to completely reshape the company. Management is basically trading up, selling off their assets in the Midwest to buy newer, better ones out west.
So here's the trade, plain and simple. They're selling off properties in Minnesota where their profit margins are kind of meh, in the low 50s. Then they're taking that cash and plowing it into high-growth spots like Colorado and Utah. And the properties there? They're looking at much juicier margins. Think mid-60s to even 70%. It's a classic move. Sell the slow and steady stuff to buy into high-growth, higher-profit assets. It's a portfolio upgrade, for sure.
So what are they actually buying? We're talking about two big properties, Sugarmont in Salt Lake City and Railway Flats in Colorado. But check this out. This is the really slick part of the deal. With the Railway Flats acquisition, they get to assume the existing debt, and the interest rate is just 3.26%. I mean, in today's world, that is basically free money. It's a huge win that makes the whole deal that much sweeter.
Now, while all this big strategic stuff is happening, this massive portfolio shuffle, management really wanted to hammer home one point. The core business is rock solid. And that's super important, right? It means they're making this big move from a position of strength, not desperation.
I mean, just look at this number for a second. 96.1% occupancy. That is incredibly high. It tells you two things. First, people really want to live in their buildings. And second, their management team is doing a fantastic job keeping those apartments full. You just can't argue with a number like that.
And it's not just about keeping the lights on, they're actually able to raise the rent. Their blended lease growth, which just means the average rent increase across both new tenants and people renewing their lease, was up 2.4%. And yeah, a lot of that came from renewals, but they're still getting positive rent growth on brand new leases, which is pretty impressive, especially with some markets like Denver being a little soft right now.
So what about the folks actually paying the rent? Are they struggling? Nope. Turns out they're in really good shape. On average, rent is only about 22.5% of their income, which is super healthy and affordable. And get this, the amount of uncollected rent, or bad debt, is just a tiny 40 basis points. That's almost nothing. It tells you they have a really stable, high-quality group of tenants.
Okay, so this brings us right back to where we started. If the operations are so strong and the strategy seems smart long-term, why on earth did the stock fall? Well, the answer is all about the future, or at least the rest of this year. It comes down to their updated guidance and the market's fear of a little short-term pain.
And to their credit to CFO Bharat Patel tackled this thing head on. He basically said, look, we know our full-year forecast is a bit lower,
But it's not because the business is getting worse. It's a direct result of us selling some properties and buying others. In other words, this was totally expected. It's a planned side effect of their big strategic move.
And when you look at the math, it's not actually that dramatic. They lowered the midpoint of their guidance by only 4 cents. And during the Q&A with analysts, they explained that the whole transaction, the selling and buying, was going to cause about a 6 to 8 cent dip this year. So the new guidance simply accounts for that. There's this temporary gap where they sold the old income-producing buildings and the new ones haven't started kicking in their full earnings power yet.
And as you can probably guess, the analysts on the call really hammered them on these points. They asked all the tough questions like, how are you justifying this short-term pain for long-term gain? What are you doing about the softness in Denver? And the big one, hey, your stock looks pretty cheap right now. Why are you buying whole buildings instead of just buying back your own shares? It's that classic debate about the best way to spend the company's money. So let's tie this all together. What's our take here at Talk Tickers? Well, this is what we'd call a classic show me story. Management has presented a really compelling, logical plan. The strategy makes sense on paper, but now they've got to go out and prove it. So the big question for any investor looking at CenterSpace is this. What do you do with this stock right now? You have this weird mix of a super stable, solid core business on one side, but on the other, you have this huge strategic shift that's causing a little bit of turbulence in the short term. So how do you price that in? For us, this puts the stock squarely in market perform territory. Basically, we think it's going to trade in line with its peers for a while. Think of it like this. The strong existing business puts a solid floor under the stock price. It's not going to collapse. But the uncertainty and the execution risk of this big pivot, that's going to act like a ceiling, keeping the stock from really taking off until we see hard proof that the strategy is paying off in the earnings reports.
Okay, so with that rating in mind, let's talk about a potential trade idea. And of course, I have to say it, this is absolutely not financial advice, just a way to think about the situation.
The play here could be what's called a pairs trade. The idea is to isolate your bet. You go long CenterSpace, meaning you buy their stock, and at the same time, you short a basket of their competitors, maybe through an ETF. So what are you betting on? You're not betting that all apartment REITs will go up. You're making a very specific bet that CenterSpace's management will execute their plan so well that their stock will outperform its peers over the next year or so, as the market starts to recognize the higher quality of their new portfolio. It really boils down to one question. Do you trust the team and bet on the plan now, or do you wait for the proof later?
This is not financial advice.